Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a forward exchange contract designated as cash flow hedge from the time the contract is made up until the settlement of it. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you would like to follow along with OneNote and you have access to OneNote, and you're not required to follow along with OneNote, but if you have access and you would like to, then it's going to be down here on the 1140 C3A2 area, and we're in the Problem Presentations tab. Closing this back up, we're going to go over all the information for the practice problem first, and then we're going to go back into it and pull pieces of that information to look into as we work through the practice problem. Now, the scenario will look much the same if you've been following along with some of the prior scenarios. We're going to go through it in detail just so if you haven't been following along with other problems, you can see the full problem. But just note it will be different, and we'll point out some of the differences that will take place and what the effect then will be. That's what we'll focus in on as we take a look at the journal entries. So we have the forward exchange contract timeline then. Forecasted transaction. So this is a forecast for a transaction to take place. The transaction that will be taking place is the purchase of inventory. Hasn't happened now. We don't have a contract for it to happen, but we believe it's going to happen in the future. We predict it's going to happen, but there's no formal agreement for it. So forecasted transaction, 81X1, forecast the purchase of goods and enter into a 240-day contract. So there's going to be foreign currency involved, and therefore we're going to enter into our forward exchange contract at this point in time, even though the transaction hasn't taken place, but we predict it's going to take place, and even though we don't have a contract, we're going to have a 240-day forward contract then, exchange contract, which is going to start today and end at the point in time that the cycle for the actual purchase will end, which means at the point in time we actually receive and then pay for the inventory. So we have the forward contract to hedge the foreign exchange currency purchase. Then we've got the exposed foreign currency payable. So then on 10/1/X1, we actually receive the inventory. So then we're going to get the inventory at that point in time. We're going to put it on the books, but we haven't yet paid for it. We bought it on account. So we're going to put the inventory on the books. And then we're going to have an accounts payable. That accounts payable, however, is going to be needed to be paid in foreign currency rather than US dollars. Then on 12/31/X1, we have the balance sheet date where we will revalue any accounts that need revaluation at that point due to the change in currency. Then on 4/1/X2, we're going to pay the accounts payable in yen with foreign currency units received from the completion of the forward exchange contract. So this whole thing comes in and comes together at 4/1/X2 when we pay off the accounts payable, which also is 240 days later than 8/1, which is the point in time that we predicted the transaction would take place, and then move forward from there. So the forward exchange contract will also expire at this point in time. The forward exchange contract providing us with the yen that we're going to need to pay off the payable in. So let's go over some of the details a little bit more. We have an 81X1P agreement purchase goods from Japanese company. So it's a forecasted, but there's no binding agreement. So we don't have a contract, but there's an agreement, right? There's an informal agreement. We expect it to happen and we expect it to move forward, but we don't have a formal contract for it. That's one of the key points that will be different than some of the prior problems that we've had. If there was a contract, then we may account for it then in a different format. Then we have on 10/1/X1, 60 days after the point in time that we made the prediction, then that's when we actually got the delivery. We got the inventory at that time. We're going to record the inventory on account and then pay for it in the future with the use of foreign currency, with the use of yen. The contract price will be the 3 million yen. Then on 4/1/X2, 180 days after the delivery, we make the payment in yen, meaning 3 million yen at that point in time. Also, what's happening is that we have on 8/1/X1, the very beginning, before we even got the inventory, P enters into a 240-day, 60 plus 180-day forward exchange contract, meaning the 240-day contract will cover the 60-day time period from the point that we believe the contract's going to be taking place, and until we get the inventory, and the 180 days from the point that we get the inventory and we pay it off, paying off the accounts payable with the foreign currency, with the yen. The future rate for the 240-day forward contract is going to be 0.0073 to 1 yen. We have the US equivalent value to the yen here. We have the spot rate and the forward exchange rates that will be necessary for the relevant dates we will be working with. the forward contract designated as a cash flow hedge from the time the contract is initially made until the final settlement. This is going to be one of the items that's going to be different than the prior transaction, the prior item we had. It's different, basically, assumption. The set of facts are basically the same, but this assumption is going to be different, and that's going to show us or result in some differences in the way we account for that. And we'll go ahead and point those out as we go. So just keep that in mind. The forward contract designated as a cash flow hedge from the time the contract is initially made on 8/1, before we actually got the inventory, until the final settlement, meaning including the time period that the accounts payable is out, right? So the accounts payable happened on when we got the inventory. So we got the inventory. We're going to call it a cash flow hedge for that entire time period. Okay, so then we're going to go back into our data. We're first going to say that the forecast on 8/1x1, that's when we forecast that the future transaction is going to take place. We're going to put our forward exchange contract on the books at that point in time, resulting in basically an asset or receivable and liability or payable. The asset is going to be the foreign currency receivable from the exchange broker in yen. So at the end of this, 240 days later, we will get the 3 million yen, which we have to currently value in US dollars, which we will do so and get to the 21,900. We'll take a look at that calculation shortly. Then we'll have the dollars payable to the exchange broker, the liability half. It is going to go on the books for the calculation that we will see shortly, and then stay on the books because it will be in dollars. So we're not going to have to revalue the payable. We will have to revalue the receivable once we put it on the books. Let's go do that calculation. We're going to say this is going to be the 3 million yen times the forward rate. So we're using the forward rate because we're looking forward to the point in time that this thing is going to end, because it's a forward exchange contract. That's going to be at April 1st. Therefore, we're using the forward rate, which is the 0.0073. 0.0073. Nothing different, nothing unusual from this transaction. That then records a debit of the 21,900 to the receivable, a credit of the 21,900 to the payable. That will look like this. Over here, I'll use the calculator as a ruler. There's the 21,900. That one, again, will change with the valuation of the currency. The payable, however, will not. We're just going to pay that off in dollars at the end of this thing, 240 days later. Next item in our transaction, we're going to say then on 10/1, that's when we actually get the inventory. So we're going to say then this transaction was the prior transaction we did. This is the current transaction. Both of those transactions will be included in the entries column here. So this entries column then includes the posting of everything up to and including the current transaction we are working on. So we're going to record the inventory on the books because we received it at this point in time. On 10/1, we received it. Therefore, it looks pretty much normal, just like a normal kind of inventory transaction. We're going to debit inventory. We're going to credit accounts payable because we purchased it on account. We have not yet paid for it. However, the accounts payable is going to be in yen. We're going to have to pay 3 million yen. And that means, and we have to record the thing on our books in dollars because we're not going to record 3 million yen. You got to, because that wouldn't fit into our financial statements. So we got to put it in dollars. So that means that we got to revalue this thing. We got the inventory, 3 million in inventory times. Now we got the inventory on 10/1, and the question is, do we use the spot rate or the forward rate? You might be saying we're going to use the forward rate because we're not going to pay for it until April, but we typically use the spot rate. Now I would basically think about that as basically we are valuing the inventory that we got right now in terms of today, right? And that means we're going to use the spot rate on the exchange rate, which is 0.007 here. So we're going to multiply this times 0.007, the spot rate, the current exchange rate, 0.007. That's going to be the 21,000. So the inventory going on the books at the 21,000, nothing really new here. This is the same kind of thing that you would basically expect for many of the scenarios, right? We're putting this on the books when we received it at the current spot rate, debiting the inventory of the 21. So there's the 21,000 there, and then the accounts payable going on the books at the 21,000. So now we have this from the forward exchange contracts receivable that's going to vary over time. We have the inventory, and then we have the accounts payable, which also will vary from the accounts payable because we're going to pay that in yen. And then this one will not vary, this payable from the forward exchange contract, because it is in dollars. Next, we're going to say it's 12/31. We have the balance sheet date. So now we got to make our adjustments to our accounts for the balance sheet date. That means, once again, this account's going to vary. This account's going to vary. We will revalue them, basically doing adjusting entries at this point. Let's see where they were before and then adjustment them as of the current date, that being December 31st. So I'm going to go back up and we'll start with the receivable. So we're going to pick up the receivable here was at $21,900. That's what we put it on the books on for. And now we're going to adjust it to December 31st. So we're going to go up top. We're going to look at our rates here. We're going to say that we have then the 3 million times the 12/31 rate, which is going to be 0.0077. So times 0.0077. That's going to give us our 23.1. We currently have on there the 21.9. So minus the 21.9. That's going to give us the $1,200 difference. That's going to result in a gain. Why is it going to result in a gain? Because last time we measured this was on, I believe, 8/1. So we had the 0.0073. That was 1 yen is equivalent to $0.0073. Now 1 yen is worth $0.0077. The yen has become stronger. And we're talking about a receivable. We're going to be receiving yen. Therefore, the fact that we're going to get something that's more valuable than it was before means that we're going to get a gain. We have a gain then. So if we record that out, we're going to have the currency receivable is going to be a $1,200 increase or debit. The gain then not going to the gain account, but rather to the other comprehensive income. That's going to be one of the things that are going to be different at this point in time. That's similar to one of the transactions we had before. But when we had the contract, it was to the gain. So this is one of the things that you want within these scenarios is going to be different. And it's going to be different in part to this transaction below, or this component below where it says forward contract designated as cash flow hedge from the time the contract is initially made until the final settlement, as well as the fact that we have a forecasted transaction as opposed to a contract for a transaction that was going to take place. So in other words, note that we're past the forecasted point. We're past the 10/1 transaction where we receive the goods. We're revaluing this as of 12/31, which is past the point in time that we received the inventory. And because it's a forward contract designated as a cash flow hedge from the time the contract is initially made until the settlement date, we're recording that not into the normal gain or loss, but including it into the other comprehensive income. So that means that we're going to have the foreign currency from the exchange broker is going to be on one side of this now at the 23,100. The other side then included in the other comprehensive income. We now have the 23,100 in the foreign currency receivable from the exchange broker. That can be calculated as the 3 million times the current forward rate, the 0.0077, and that's going to be the 23.1. And we can also calculate that 1,200 another way, which could be useful to know, which is 0.0077 minus the 0.0073 times the 3 million. So that's useful to have. You'll see that oftentimes. So then that's the 1,200. Let's go on down. So next transaction we're going to have, all the previous transactions are here, and the current transaction will be this one. Those are all included in the entries column. Now we will be revaluing the accounts payable. So we're revaluing the accounts payable. Let's look at that prior to this. Let's look at that in the prior slide to see what it was before we do the revaluation for 12/31. So I'm going to go back up here. It was on the books at the 21,000 before. Now we're going to say we're going to bring it to the current point. We're going to use the exchange rate to do that, or the spot rate, the current exchange rate, rather than the forward exchange rate. That's going to be 3 million then times the current spot rate, which is times 0.008. I think I missed a zero. Let's do that again. 3 million times 0.008. That's going to be the 24,000. 24,000 minus what's currently in there, the 21,000, is going to be a $3,000 difference. That $3,000 difference will be a loss. And we know it's going to be a loss, one, because it's the opposite of what happened up here when we revalued the receivable, which is what would make sense. It's going the opposite direction. And if we consider the rates, then last time the rate was on the books we put it on the books at 10/1, I believe. So it's 0.007. was 1 yen is $0.007. Now 1 yen is worth $0.008. The yen has gotten stronger. This is something we're going to be paying in yen. Therefore, we're going to be paying in something that is more valuable. And so we're going to have a loss as a result of it. So let's see what that will look like. We're going to say that we're going to have the loss, the foreign currency loss. Notice we're recording it up top as the loss, and then we're going to make an adjustment for it after this, basically moving it down to the other comprehensive income. So we're showing it as a loss right there on the income statement, the other side going into the accounts payable. Accounts payable now included in this item. We are now at 24,000 for the accounts payable. That calculated as the 3 million times the 0.008. That's going to be the 24,000. Also note that we can calculate the 3,000 down here by saying the difference in the rates, which are 0.008 minus 0.007 times the 3 million. That's going to be the 3,000 there as well. Okay, let's scroll down to the next item then. Next item we will have, remember that all these items thus far, and including the current item we are working on, are in the entries column here. Now we're going to make an adjustment, basically moving out that loss that we recorded up top on the income statement to basically other comprehensive income. We will do that by netting it out with a gain. So we're going to record a gain, which will basically net it out. So that means the net effect is 0 here, moving it into the other comprehensive income, which basically has a loss reflected in it from the transactions thus far. So we've removed it basically from the normal income statement items, put it into basically the other comprehensive income with this transaction as of 12/31/X1. Next, we're going to say that it's next year now, and this is when everything is going to end because the accounts payable will be due. We're going to owe the 3 million yen at that point in time, and the forward contract will expire at the same point because we set it up in order to do so in that way. So now we have the ending balances. Here are our ending balances. Those will then be our beginning balances for the year 2. And then the equity accounts are now closed out, including other comprehensive income into, I'm just going to put it all in lumped into the equity section. So this, in essence, is our post-closing trial balance after year 1 or our beginning trial balance for year 2 with no items in the temporary accounts and no items in other income. They've all been closed out into the equity, which we're just going to represent with one account, the equity account up top. So now we're gonna say now it's 4/1/X2. We're gonna have to do our same revaluation. We're gonna do our revaluation for the receivable, the revaluation then for the payable. Let's start it out with the receivable. We know what it was last time because we see it in the beginning balance here at the 23,100. We're gonna adjust it for the current point in time, which is gonna be April 1st. So we're gonna take our 3 million then, 3 million yen times the 0.0076. That's gonna give us our 22,800. 22,800. Notice I took it times 0.0076 instead of the forward exchange rate. Why? Because the forward exchange rate was pointing to a forward point in time, that point in time that we've been waiting to happen, that special date being April 1st, which is the current date we are on. So we no longer are looking forward, but are in that current time right now. That is the present in our practice problem. So if you look at your calendar and your date and your watch right now, it's actually for April 1st, 2000X2. So we're going to adjust then to 22.8. We currently have 23.1 in it. So if I subtract this minus the 23.1, we have a $300 difference. That $300 difference is going to result in a loss. Why does it result in a loss? Well, because last time we had 1 yen was worth $0.0077, and now 1 yen's worth $0.0076. The yen now is weaker because it's worth less dollars, and we're talking about a receivable which we're going to get paid in yen, which is now weaker, so that means we're going to have a loss. However, we're not going to put it into the loss account down here, but instead into the other comprehensive income, because this is on the forward exchange contract. Basically the same reasoning here is why we're putting it still into the other comprehensive income account. The other side then going to the foreign currency receivable from the exchange broker. That means other comprehensive down here is being affected, and we have the foreign currency from the exchange broker here. Now we're at that 22.8, basically valuing it as of this time period, as of this point, which is the time this thing is going to end. So we're going to have the receivable. We're going to get our $3 million or 3 million yen, which is valued at $22,800. So that's going to be 3 million one more time times the, let's do that again. Something happened. Something funny happened there. So it's going to be 3 million times the 0.0076. And there, once again, is our 22.8 that we're going to get paid from the broker, the 3 million yen, which will equal $22,800. Okay, next thing that's going to happen is we're going to do the same thing for the accounts payable. So we have the accounts payable here, and this is what it was before, the 24,000. Then we're going to make our adjustment for it. So the adjustment as of the end of the year, once again, same calculation, because everything is coming together at this point in time. We're taking the 3 million, in other words, valuing the accounts payable as of the current time period, which is 41x2, in accordance with the spot rate, because that's all we have, because we're at the current date at this point. So times the 0.0076, that's going to be that 22.8. Once again, if we take that minus the 24,000 that's currently in there, we're going to be then getting the adjustment of 1,200. That 1,200 will be a gain. Why is it a gain? Well, one reason, or one thing that we would expect, is that it's the opposite of basically the loss we took up here with regards to the receivable. And you would think that being the case because we're talking about a payable versus the receivable here. And also, if you think about the rates that we had before, it was 1 yen versus $0.008. Now it's 1 yen is $0.0076. Yen has gotten weaker because it's worth less dollars. And this time we're talking about us paying in yen. So we're paying with something that's now worth less than it was before. So that's a gain to us. So we're going to say debit the accounts payable of 1,200, and then we're going to credit the foreign currency gain down here. Foreign currency gain being the credit. So there it is. Notice it's in the gain account. So we have this included in the gain account, as opposed to the other comprehensive income, this not being part of the forward contract. However, we will reassign it, as we saw in the prior year, using a related loss, and then move it to the other comprehensive income. So look for that next time. So then we have the accounts payable. The accounts payable recorded at that 22.8 now, and then we have the gain. That 22.8 is once again calculated as the 3 million times the 0.0076, that then being the 22.8. So that's going to be our 22.8 there. That represents the fact that we're going to pay 3 million yen, which happens to be $22,800. So we're going to actually pay the 3 million yen, which is the $22,800. Okay, so next item that we're going to have is that moving that we talked about of the gain the gain that we have to other comprehensive income. So we had a gain here, and now we're going to basically reflect a loss to net it out. So we recorded the gain. We're going to now record a loss to net it out on the income statement, put the difference into other comprehensive income. So the effect of this then netting out the effect on the normal income statement and moving it then to the other section into other comprehensive income down here. Next, we're going to say that we have, we're going to pay off the payable that we have. So the payable on the books, this was for the forward contract, was on the books for the 21,900. So we have the 21,900 payable. We're simply going to pay it off because it is in cash. You'll recall that this thing just sat there the whole time. We haven't done anything to it. In other words, it was the 3 million times the forward rate at 8.1 when we put the forward contract on the book way back when, like the first thing we did pretty much. And that's the 21.9. So we put the forward contract on the books, and this one, this 21.9, this side of it, we said we're just going to pay that off at the end of it in dollars. We didn't change it for forward contract, exchange rates, nothing. It just sat there the whole time. Now we're going to pay it off because it's 240 days later, and that means it ended on 4/1, and that's when we said we were going to pay it, so we're going to pay it. So that means the cash is going to go down, so we're going to credit the cash. The debit then going to the dollars payable to the exchange broker, recording that out then. We can see, of course, the cash then going down. We have then the dollars payable to the exchange broker, that then decreasing down to zero. Nothing unusual or difficult happening there because it's all in dollars. So then we have everything up until this point has been recorded here, and including this transaction is included, you'll recall once again, in the entries column over here. The next thing that's going to happen is we're going to say the other side of the forward exchange contract will happen. To think about that, let's move up and make sure that to the prior slide and see where we were at before this. We have the receivable on the books now at that 22.8, which you will recall we revalued to 22.8, meaning the receivable is actually going to be receivable in yen, 3 million yen, which we now valued at $22,800. We're now going to get the 3 million yen from the broker, value them at the 22.8, the spot rate, because it's the same point in time, the same date, put them on the books as foreign currency units, representing the actual units that we have, 3 million yen, that we're going to put on the books at the current price, which is $22,800. So we're then going to say, all right, now we've got units, we've got this asset of foreign currency in units, the 3 million yen on the books at the $22,800. We're going to remove then the receivable. Once again, that 22.8, of course, is calculated as the 3 million times the 0.0076. There's the 22.8. Okay, so then we're going to put that on the books here. So we've got the foreign currency is now on the books. That's going to be here. It's an asset. It's not cash, but it's kind of like cash, but it's foreign currency cash. So we have it on the books as an asset, kind of like stocks or anything else that we're valuing in terms of dollars, cash dollars. And then we've got the foreign currency receivable is now off the books. So we've now received on that. Now you'll note, of course, we have the foreign currency, $22,800 worth of yen, which is 3 million yen in our problem here. And then we have the payable on the books represented the fact that we owe $22,800 worth of yen, which is actually 3 million yen. And so now we can pay the 3 million yen and remove the dollar representation of that 3 million yen on the receivable and payable side, which is what we'll do next time. So now we're going to say that the payable is going to go off the books. It's a credit. We're just going to debit it for the 22,800. Notice that 22,800, of course, once again, represents the 3 million yen, which we're actually exchanging. The other side then being the foreign currency units, the 22,800 representing the 3 million yen that we're actually exchanging. So that means that the foreign currency in units will then be going down here to 0. And we can see that the accounts payable then, or the foreign currency units is going down, and the accounts payable is going down. So the accounts payable then goes down to 0. So then at this point in time, we now have, and we're not quite done yet, but just know that at this point in time, we have cash at the 78.1. We've got the foreign currency units are now back down to 0 because we got those at the end of the forward exchange contract, but then used them to pay off the accounts payable that we had for the inventory that we purchased from the Japanese company. And then we've got the foreign currency receivable from the exchange broker has now been received. So we received that, but then we used it to pay off the payable. And then we have the inventory on the books. This is kind of like the key point. We got the inventory on the books. This is the thing that can differ from scenario to scenario. It's on the books at the 21,000, and that's the same as normal, which means it was the 3 million times the 0.007, which was the spot rate at the point in time we got the inventory. That's normal. That's what we would normally do, because that's when we got the inventory. We valued it at that point in time, even though we had not yet paid for it for the 21,000, and then did nothing to it after that. We didn't change it, even though we had not yet paid for it. We didn't change it for the foreign currency value of the forward contract before we got it or anything like that. But we did record in other comprehensive income some of the items related to the foreign currency transactions into the other comprehensive income. Notice we've been netting them out. We've been recording the items related to the forward contract directly into the other comprehensive income and netting out the accounts payable differences and into other comprehensive income as well. And so now, although they have not been capitalized in inventory up here, we will take them into account when we actually make the sale. So we actually recorded them in other comprehensive income. The prior year, year one, other comprehensive income has rolled into, we're just going to say the equity section here. So, and then the current year, other comprehensive income is here. Nothing's in the normal income because it got basically netted out. It's showing, but then it got netted out. So then we're going to say, let's pretend we make a sale then. We're going to say, we assume that we sell all the inventory that was on the books related to this transaction in the next time period. Then what would normally happen is you'd have the normal sale, which would be, debit accounts receivable or cash and then credit revenue. We're not going to think about that because we're concentrating on the other side. The other side would typically be, well, you take the inventory off the books, credit inventory, and debit the cost of goods sold, right? That would be this transaction. But we're also then going to account for the fact that the comprehensive income was affected and basically reverse the effect out there as well. So that's going to be the other comprehensive income. You'll note had the 900 in it before. So we're going to remove basically the 900. We're going to remove that. And it basically had 900 in it that was in there from year one that rolled into basically, I'm going to say it's included in this equity section as we closed out other comprehensive income in year one. So both those items now are taken into account, and that's been happening throughout the entire length of this item, and that's this scenario, and that's because the forward contract designated as a cash flow hedge. It was designated as a cash flow hedge from the time the contract is initially made until the final settlement. So therefore, we basically treated it in this way due to that, due to that difference. So now we're going to basically reverse out everything that happened to the other comprehensive income, including prior year and current year, and then the difference here is going to be affected in the cost of goods sold, which is the 900. But remember, the 900 is basically taking into consideration what happened last year in the equity, which actually was 1,800, was the effect in other comprehensive income in year one, and then the effect in other comprehensive income in year two is this 900, resulting in a net effect to the cost of goods sold of the 900. And so that's going to be then included in the cost of goods sold. So bottom line, we didn't capitalize the change in the currencies on either the forward contract or the accounts payable differences into the inventory. However, we did put it in those differences into other comprehensive income, and then we're reflecting or reversing them out into cost of goods sold at the point in time that we assume the sale takes place.